Hey, hello, and welcome everybody to today's workshop. I'm excited to be coming in and chatting with you today. I was not able to get on Sunday, and you know I like to come here every Sunday, 2 p.m. Pacific time to bring you a workshop. But for those that don't know me, my name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. And I wanted to talk to you today about a couple things because the stock market has been quite weird lately. I think there's a lot of people that are probably a little bit stressed out on what they should be doing. Now with everything going on, there's just so much uncertainty still. It looks like we might be opening up the country soon. That's a maybe. It might open up in certain places faster than others. So it doesn't look like this is quite over. But, there are some businesses that are doing really well, other businesses that are not doing very well. There's a lot of people that are still continuing to work and working from home or virtually. There's a lot of people that are completely out of work and living on unemployment. So it's a very, very weird time. So I wanted to talk to you today just really about investing and, maybe give you some insights on how to think about it. I don't want to tell you how to think about it. I just want to give you some data, and give you some insights and kind of share with you how I think about it and try to bring things back to a rational place and to a long-term perspective, right? Because that can be hard sometimes when we are looking at, volatility like we've seen recently, right? And there's also something when it comes to behavioral investing or investor biases called recency bias as well, right? And this is something that I saw coming up a lot. And so what recency bias is you make your decisions based on recent history, and you are, instead of looking at long-term history or long-term implications, you're just looking at what's happening in recent times. And so, when you look at, we've talked about this here before, like let's say the S&P 500 returns from 2010 to 2019, they look great. But the S&P 500 returns from 2000 of January to December 2009, not great, actually negative, right? So I want to just kind of just bring some data, right? And as I love to say here, this is a great saying I got from someone who I respect highly, but bring the data and not the drama, right? And what came up recently is I was having a conversation actually today with one of my reps. So as a financial advisor, we have representatives sometimes with maybe some mutual fund companies that we use. And I was talking to my rep today, and he was like, did you notice that when you look at the long-term returns of the bond market versus the stock market over the last 20 years, as of the end of last month, it actually is looking pretty interesting. And so we're going to talk about that today a little bit. I'm going to share with you some thoughts on that and some actual data, and then also talk more about some of the longer term implications. But I also have a very special announcement. Okay, so for those of you that are dealing with situations where you maybe own a small business and you're looking into things like the PPP loan, the Paycheck Protection Program loan, or the EIDL, Economic Impact Disaster Loan. I think that's what it stands for. But these are the two government loan programs that basically ran out of funds last week, but it looks like everything just got approved today for more funding. I'm actually going to be bringing somebody on tomorrow here. Okay, so tomorrow here live, 2 p.m. Pacific time, 5 p.m. Eastern time. I'm going to bring her information up here. Let me share this with you in just a second. I'm going to bring on somebody very special. Okay. So this is my good friend, actually a friend of my wife's, named Claudia Schad, and I've met her multiple times before. She's excellent, very, very intelligent. But we're going to be doing a presentation tomorrow discussing the differences between the EIDL and the PPP requirements. And then what Claudia does, she's actually a lead business advisor for a nonprofit that helps small businesses. And so what she's really specializes in is getting you ready and getting people ready so that when they go to the banks for these loans, or this is just in general any sort of small business funding because it's her specialty, but that they are ready. Okay, so there's been a lot of loans given out. There's a lot of controversy actually because some of these big, massive Fortune 500 companies are taking loans. Thank goodness our president is going to be asking them to return some of that money because this is really designed for small businesses, mom and pop shops. If you're multi-hundred billion dollar business, I don't think you should be taking $10 million, or whatever it may be from these programs. That money needs to go back. So it looks like this funding is going to be approved. And what we want to talk to you about is if this is something that's of need, then I want to help you get prepared, okay? And I've been studying this stuff. I know a good amount about it, but in all honesty, there's new things coming every day. And so Claudia's on the front lines, really dealing with this stuff, filing the paperwork, seeing what mistakes people are making, and seeing the misconceptions people have about these programs. So tomorrow, 4/22 at 2 p.m. Pacific time, we're going to be here, okay? So all you got to do is tune into the page here. After this workshop, then I will post the link so that you can follow that, and you can turn on the notifications if you like, so that you can check this out live. But it's going to be very good. She's a deep expert in this, so if you have any interest in EIDL or PPP loans and the requirements, we'll talk about forgiveness, what that looks like. Definitely want to tune in tomorrow, okay? So let's talk a little bit about what we're here to talk about today. Let's see here. Give me 1 second. And before I jump to the next section, this is what we're going to talk about today. Don't stocks typically outperform bonds, right? So we're going to talk about this today. And it's actually some really interesting data, that's going on that my rep pointed out to me, and now I want to share with you. I think it's going to be really cool for you to notice. But before we get into this, I have to make it clear that everything I talk about today, I'm going to give you a lot of data, a lot of good information. But please do not take this as financial advice, tax advice, investing advice, any sort of advice, okay? This is just me showing you the data, okay? So please take it as that, right? So let's switch over here to what we're going to be talking about today. And if you have any questions as well, by the way, go ahead and put those in the chat. Put the questions down below in the chat, and then I will do my best to answer those questions before we wrap up today. So don't stocks always outperform bonds, right? So this is going to be, I think something very interesting. Oops, let me switch my screen here to this one here. There we go. Okay, so let's talk about this a little bit. So what is this? Okay, I know some of you really you see graphs and numbers and it's just not your thing and it just makes you want to zone out. Don't worry about that too much. All I want to do is kind of show you some basics here and really help you understand, the importance of some of this stuff and just try to make it, again, I'm all about keeping it simple. So I want to just make this as simple as possible for you so that you can learn something today, maybe get some insights that you didn't have, and, look at things a little bit differently when it comes to, looking at your investments over the long term, okay? So what this is all this is basically an index, okay? So this is the returns of the U.S. bond index over the last 20 years up until March 31st, okay? So of 2020. So as you can see here, it's 1/1/2000 to 3/31/2020, okay? So this is the kind of the U.S., like I said, Barclays U.S. bond index. So if you look at this over time, it's returned on average since January 1st, 2000, 5.12%, okay? So if you look at the periods here, this has been basically the average returns of this index over this time, generally positive, but we have had some negative years. And so, again, there's been some years where it's been flat, but overall, it's done decently well. And I think most people would be pretty happy with this performance. Well, what's interesting, at least to me, is that sometimes, and even as a financial advisor, right, we're just like, oh yeah, it is no question that the stocks are going to outperform bonds. That's one of those things. And we know they don't do that every year, but we generally say over a long period of time, that could be the case. But what we're looking at here is a 20-year history, okay? So it's just about a 20-year history. So if you are 65 going into retirement, this would be potentially returns from 65 to 85 if you went in retirement in January 1st, 2000. Same thing here. If you put money in on the first of the year in 2000, this is what it would return. Okay, so what I want to do is compare this. And I want to compare this for you to the S&P 500 index fund. Okay, so all this is a comparison to the S&P 500. Nothing fancy here. But as you can see, as of March 31st, 2000, the S&P has actually done a little bit worse than just having everything in a straight bond fund. Obviously, right before this, we had a huge increase. Okay, but this is the thing: if you're invested this time, we're looking at today. What are we looking at today when it comes to your investing on the long term? And if you would have put money in the same day into these funds, you would have been a negative return from 2000 all the way until basically 2017. So this would have been a period of underperformance of almost 17 years where you would have essentially could have kept all your money in a very, very overall safe, type of fund versus taking the extra risk of throwing your money into something like the S&P 500. And, obviously things crossed over here and they've had some couple cross points. But when you're looking at, as of the end of the month, the average returns have been, 4.84 for the S&P versus 5.12 for the U.S., bond market. So I thought that was really interesting. And it was pretty shocking to me that, you would have been investing for 20 years, taking all this extra risk, riding all these ups and downs here, right? You've been riding this roller coaster all the way up and down, but ended up in the same place just over 20 years later. So again, obviously we have some places here where things outperformed and it was doing quite well before we had this big market dip. But at the end of the day, we did have a period from 2000, or excuse me, not from 2000, but from 2010 to 2019 where, the S&P did very, very well, right? But again, when you're looking at investing long term, this is something you really want to be thinking about and saying, hey, is the risk I'm taking going to be worth it, right? And the reason I bring this up too is I've talked to a lot of people and I've seen a lot of people that were getting close to retirement, right? They were maybe 1 year, 2 years away, and they were still keeping, 80% or 90% of the retirement investments in equities, right? And for a lot of people, it was large cap US stocks, which is basically what the S&P 500 is. And they were putting all their money, a big chunk of it, 80, 90% into a stock fund because they were trying to eke out a couple extra percent right before they retired. And this is where it can get really dangerous, right? It can get really, really dangerous where if you were here, let's say here on, let me move this out so I can see, on February, 14th, and things were looking good, and then you go here to, March, where are we at here? Where did this actually dip? March, 24th, 23rd, somewhere in that range, March 30th, somewhere down here. And now your whole portfolio just takes a huge dip, right? And now you're asking yourself questions like, oh, can I actually retire? Should I retire? These type of things. So, when it comes to making your investment plan and creating your plan, you really want to make sure that you're taking into account not only the returns, but also the risk, right? So, most people don't have either 100% S&P or 100% bonds. This is kind of two extremes I'm showing you here. So what I also want to share with you is a couple, blended portfolios. Okay. So let's just take, if we were to use similar, funds and we just blended this with a 60-40. Okay. So we're talking about 60% US stocks. So basically the S&P and 40% US bonds. So basically the bond market. We're looking here at the orange one now. Okay. So if we were to look at the orange here, which is this blended 60-40, and you started here on the same day, here's what's really interesting is, you would have faced some downturns, but not quite as much as having all in S&P. And you would have had a crossover point, about the same. But if you look at your actual return, your actual return still would have been a little bit higher, even though you were lower risk over this period. You would have returned higher than both the S&P and the bond market separately by putting those together. And what's the reason for that? The reason for that is because you're actually be facing less volatility, right? So you're participating here on the upside when we have the big upsides. But as you can see, this orange line never went down to the blue line because you had some sort of bonds or some sort of fixed income allocation that acted as a shock absorber, right? Didn't quite act as much of a shock absorber as we had 100% bond, but we also got to participate in the upside over this period where we really saw this terror. And it really starts here, as you can see, in 2017, January 17th or so. This is when the equities market really started picking up. And really about November 2017, things really started taking off. And that's where we saw these big gains in the market. So, where we're at today is basically, we're still higher than we were back in 2016. So we're still a little bit ahead there if you had some sort of portfolio here. But this is something that a lot of people just don't really realize. They really try to, I don't want to call it getting greedy, but let's just use greedy as terminology. You're 1 or 2 years away from retirement. Let's say this is 2017. So we're in 2017 right here, right? Let's say your retirement is 2019. And you used to see in the market looks like it's going up. So you start moving your money over, 60, 70, 80, 90% stocks. You think things are going great. And then boom, out of nowhere, you're going to face this huge dip that we're looking at, we're currently in right now. But you know, if you were in 60-40, you still would have ended up a little bit better. So what does this mean in actual dollars, right? Let's look at a value here, okay? So this graph here assumes that you started with $100,000 back on January 1st of 2000, okay? So if you look over here to the right, what you would have had right now, so the blue line here is the S&P 500, okay? So the S&P, you would have had $260,671. So your $100,000 investment as of March 31st, 2020, end of the first quarter, would have been worth $260,671. So not bad. If you were 100% bond, U.S. aggregate, just basic index, you know, Barclays index there, you'd be at 275, 268. But if you had a blended portfolio of 60-40, you'd actually be higher at 282, 800. So this is really interesting, right? That you can take less risk, but because of the lower volatility that you're going to have, you're not going to face as big of high and lows. You can actually come out ahead sometimes when there is additional market turbulence. So I thought this was really interesting. So let me compare this to one more thing before we jump into the next discussion here. So if we look at a 50-50 allocation, so that's what this new one is here. So we're getting just a lot of stuff. So I'm going to take this off for a second. If we look at a 50-50 allocation, we take off the 60-40 as well. The 50-50 allocation returned, 5.3% average. So the 50-50 you would actually been, a little bit higher as well. But if you look at how much less volatility you would have had to face here, it's actually not too far off what you dealt with having a full bond exposure. And if we add back in our S&P, it would have been about half the volatility here of the S&P, right? But you still end up with your 50-50, you're still ending up ahead here. So again, a lot of this stuff can be gamed in a sense, right? A lot of it can be gamed in a sense where you can pick a certain time period and, make things look a lot better just based on a certain time period. But this particular one is just literally, a 20-year period and then up to the most recent quarter. So I can switch that back and share with you to the actual full 20 years, but it's not that much different. So again, my whole thing I want to talk about today is consider making sure that you have a properly diversified portfolio, okay? And so now I want to talk a little bit about some more data here. And now all I'm showing you here is kind of U.S. versus, U.S. stock versus bonds, but there's actually a whole world of potential investments as well when you go global, right? And so I want to share with you today a presentation that I think is going to be helpful for you. It's going to get a little bit nerd level, okay? So the stuff I talked about to you today so far, I wanted to keep it real basic. I'm going to move into a little bit of nerd level, but hopefully this helps you understand a little bit more and can give you some more insight on why considering globally diversifying could be a good idea depending on your goals, your timeline, and everything like that. So let me pull this up here. Let me swap over to my other screen here. Excuse me just a second while I do that. Let's see here. Why is this giving me some trouble? Give me one second. Oh, here we go. Okay. Sorry about that. Let me switch over to my PowerPoint. All right. Here we go. Now we are in business. All right. So, okay. So like I said, this is a little bit nerd level. Hopefully, again, you find value in this. But what I'm trying to display to you here with these is that it's nearly impossible. Okay, it's basically impossible to predict market performance, right? And there's so many things that come into play, and there's so much randomness when it comes to the returns of markets, and depending on the particular index you're looking at, that I find and I believe that it's much better to have a diversified portfolio so that you are always participating when you have those outshining years. Part of the time you're going to have to deal with some things that are underperforming potentially, but over long periods of time you're not going to have big misses in your portfolio to where you missed out, like I brought up initially, where January 2000 to December 2009, the S&P returned -1%, right? So global investing is super, super important, and we're going to talk a little bit about some of these talking points here. Okay, so hopefully you enjoy this. Hopefully it's not too nerd level. Okay, if you're watching on your phone, you may need to zoom in or move to a computer, but or move to an iPad at least. But let me turn off my actual one little thing here before we get into this. All right, let me get my face out of there so you can see all this. Cool. Great. All right, so what this is here, this example is the annual performance of major asset classes in the U.S., international, and emerging markets over the most recent 15-year period. So the top chart ranks the annual returns from highest to lowest using the colors that correspond to the asset classes. So, for example, here, okay, 2005, the highest return was 34.5%, and that was here in emerging markets, right? So the blue here matches with the blue. In 2006, we got this purple. We had 36% return, and that was from U.S. real estate. 2007, we had a 39.8% return, and that was, let's see here, what was that here? I think that was that's emerging markets again. 2008 looks like 5-year government fixed income was the top. So as you can see here, these things are changing every year, right? Emerging markets had, like 2009 emerging markets was a 79% return. That's pretty amazing. So this is just to share with you here that it's not going to be consistent where you're going to get your returns from in general. Generally it's going to be, different asset classes that have different returns each year, which is why diversification is super important. So, in both U.S. and non-U.S. markets, there is little predictability in asset class performance from one year to the next. So what we're going to look at here, we're going to study the annual data in the slide, but this reveals here that there's really no obvious pattern in returns that can be exploited for excess profits, which strengthens the case, right? So this strengthens the case I'm making here for broad diversification across many asset classes. Okay. This next screen here is an example of some model portfolios that you could possibly consider for allocations. But investors need portfolios that reflect their financial goals, time horizons, and risk preferences. So when you're building a portfolio for yourself, like I mentioned before, maybe you want to be 100% stock, but maybe that's not right for you. Everybody is different. You need to create your portfolio based on your financial goals, your time horizon, and your risk preferences. There's no such thing as a perfect portfolio. And most investors will find that just taking a sensible approach does incorporate diversification across the global markets, okay? So I'm a big fan of global investing. It looks pretty rough right now. It really does. But we just don't know when these returns can show up. And so even though the non-US markets look a little bit rough, sometimes these things just show up before we expect them to. So, if you are going to be looking at a diversified portfolio, creating your plan and sticking with it is part of the challenge of being a disciplined and diligent investor. But this slide illustrates how various model portfolios might be constructed to capture the market size and value premiums in global markets. So to simplify this illustration, the relative proportion invested in equities remains fixed. The changes to the model portfolios involve diversifying across a greater number of equity dimensions in both U.S. and non-U.S. markets as represented by the indices. So this is just some examples for you of what you can consider for model portfolios. Okay, let's talk about here a little bit about historical returns. Okay, historical returns, what you're going to see here on the top graph, we're looking at year-to-year returns from highest to lowest. Okay, so the highest returns in 2004 looks like it came from the equity markets, right? So 100% equity. And the lowest returns were from the fixed markets in 2004. When you get to 2007, the highest returns were in the fixed market and the lowest returns were in the equity market, right? So the lower chart, features the historical and the performance of model portfolios over the most recent 15-year period. So if you're looking at these model portfolios, kind of like I laid out for you in the previous slide, here is what they are 80-20, 60-40, 40-60, 20-80, 100% fixed, and then 100% equities. And then these are what the returns would have been, over this time. So as you can see here, the annualized return for this period for 100% equity portfolio would have been 8.18. But this is a global allocation. You have to remember that. Okay, so it's not just the just the U.S. only or just the S&P. 80-20 would have returned 7.22. 60-40, 6.14, 40-60, 4.94. So generally, it does correlate, higher equity exposure does generally correlate to better return. But as I showed you on the previous graph, that currently over the last 20 years up until the end of last month, the bond market actually outperformed the S&P over a 20-year period. So it's a very interesting times I think we're in here. Okay. So this next slide here is to demonstrate the randomness of returns looking at different sectors. Okay. So if you have, let's say an S&P 500 fund, you're going to have different sectors within that fund. So as you can see here, though these correlate by color. In 2009, the highest return was 64.47, and that was from the technology sector. Okay. The lowest return was 11.17, that was in utilities. If you go to 2010 here, the highest return was in consumer discretionary, and the lowest return here was in healthcare. For many years, healthcare has been higher. So if you look at 2013 and 14, healthcare has been knocking it out of the park in those years. So again, this goes back to the randomness of these results. And again, just illustrates a lack of predictability in performance rankings from one year to the next. And it just shows, again, no obvious pattern. So again, you want to make sure you're properly diversified. And many portfolios that I've done analysis on recently have just been heavily weighted in one area. Just way too much US or way too much all in large cap US or just, way too much international, whatever it may be. There's been a lot of things I've been seeing lately that just don't really align with capturing the premiums in the different areas of the market returns. Okay, so hopefully, again, you guys can see this. Hopefully you like this. Okay, so this is going to be overwhelming. Hopefully not. I'm going to try to make this real simple. All this is trying to display here is the equity returns of developed markets. Okay, so you really, when it comes to like equity markets, you really have three main categories. You're going to have, U.S., so like kind of developed U.S. markets, because we're the biggest when it comes to like global market cap. U.S. is the biggest. Then you're going to have non-U.S. developed markets. So as you see here, this will be companies here or countries here like Switzerland, New Zealand, Sweden, Austria, Canada, Spain, Finland, Japan, Norway. So think when I explain this to people, I say, think about companies like Nestle, right? Nestle is a water/candy bar company. I believe they're out of Sweden, I believe that's right. Think about Shell Oil, right? Shell Oil is international. Think about Toyota, right? Toyota is in Japan. Those would be considered developed market, non-U.S. stocks. So as you can see here, what this does is ranks on the lowest return on the bottom to the highest return on the top for each of these years. So as you can see, 1 year was Switzerland, the next year New Zealand, a couple years later Sweden. And when Sweden showed up, it was 64.5% return, right? The next year, 2004, was Austria, 71.5%. If you go to recent times, the highest return in 2019 was in New Zealand at 38.2. In 2018, it was actually, the highest return was negative 3%. If you go to 2017, Austria was 58.3. So again, what I'm trying to display to you here, and I'm kind of beating a dead horse, but I'm doing it on purpose, is that we can never really predict exactly when and where the returns are going to show up, which is why you really want to, want to own as much of the global allocation as you can. So I'm sorry, this actually includes US as well. So as you can see here, the US, in 2019 was 30.9, but that wasn't even the highest return. And US here, if you look at US with this blue color, we're generally somewhere near the top, but right here we're floating in the middle at 0.7. In 2013, we were near the top here. 2014, we were at the top, but as you can see, the best returns over any year generally don't come from the US, right? And there's many years where the US down here is one of the worst when it comes to performance. So 2009, the US was one of the worst. In 2007, we only returned 5%. So again, one of the worst. So this is why global investing, many investors just really don't understand or aren't open to it. There's something called home bias where it's like, because we can see it and touch it, we feel better about it, right? So, we're in the US for most people watching this, by the way, I think probably 90+%. So we probably feel good about understanding companies, that are in the US. But what we also don't always think about is many of the largest companies are global companies, right? So like Apple, that's a global company. They're doing things all around the world. So again, this is just to demonstrate the randomness of returns and that it's just really hard to predict market performance at any one particular time. So you want to make sure that you are having a globally diversified portfolio, okay? All right, this next slide here is to talk about equity returns of developed markets, okay? So developed markets, again, here, Austria, Belgium, Canada, and so forth, right? US is down at the bottom here. So if you look at the annual returns and you look at where things were showing up, the highlighted boxes, for each year show you where the highest return was at that time. The U.S. was here, but that's the only time it's really been highlighted in the last 19 years or so, 20 years or so. Basically, every other year, there's been some other country that's held the trophy for highest returns. So again, it's when you look at the global market as a whole, the last decade hasn't been so great. Over 40 or 50 years, it's done well. But it's really hard sometimes when you are trying to make your own investment decisions to say, hey, am I including all the right data? Am I properly diversifying my portfolio? So this is why I want to bring this up to you today. So as you're thinking about this, especially now, where I think having a properly diversified portfolio is more important than ever. It's going to be it's really going to be a very interesting time that we're going to be experiencing here going into this next decade. So I think there's going to be a lot of unpredictability. I think again, it just doesn't look good overall. I think there's going to be the big companies that are going to do just fine over this next decade. But we're going to see a lot of companies, a lot of sectors struggle, right? So it's going to be a mixed bag of what we're going to get. Because if you look at companies like Amazon, Facebook, how much time and how much money are we pumping into those right now because we're on this lockdown? Everybody's ordering on Amazon. Very few people are going to the mom and pop shops, right? But if you look at over what's going to happen in the next 10 years, is that going to continue? What are things going to look like sports, right? So sports games, entertainment, nightclubs, restaurants. What are those areas going to look like? That might be a little bit rough there. But will other sectors perform really, really well? Most likely, right? So these are things that are really going to come into play as you are putting together your investment plan for retirement. And then to add on top of that, when you're looking at retirement investments, you really want to make sure you're keeping money safe that you're going to need in the next certain number of years. Maybe it's 1 to 5 years, somewhere in that range. But the money you don't need for 15 years or more, that money could definitely be invested more aggressively. So the big thing that people are going to want to be doing is generating income right now to make sure that they have that guaranteed income. And with the interest rates dropping, annuities aren't looking so great. So, they could be used for a portion, but if you're going to lock in something for 10 years and the annuities are paying, I don't know, maybe 1.5, maybe 2%, it's really going to be tough to have a consistent income generation over the next 15, 20, or 30 years. So, properly diversifying your portfolio, reviewing it at least on an annual basis, maybe semi-annual basis, saying, hey, am I still happy with what I did? Do I want to make changes? Obviously, you don't want to be making too many changes too quickly because when you set an investment plan, you really want to stick with that plan, right? You don't want to be jumping in and out of the market because then you go to market timing. And if you try to do market timing, well, you might be missing out. Like I showed you on this previous chart, you're just not going to know necessarily where the returns are going to be popping up that are more guaranteed, for example, every year. You're just not going to know. So diversified portfolio, having different money in different sectors will really help you capture those returns. And then maybe tilting your portfolio towards things that have been showing outperformance in recent times. So these are the type of things, this is the type of data we get into when we're looking at building a portfolio and a retirement income plan for our clients. So, hopefully you found this interesting today. Hopefully you got some insight here on how to think about building a retirement portfolio and making sure that you're properly diversified and having a good allocation that does, help you invest globally, because it's going to be an interesting time coming up here. But I think we're in a good place that if you make smart decisions, you can do very well over this next decade. I really, really think you do. But if you just take everything out, put it in cash, I think you might have some challenges. And who knows, maybe cash could do okay. But in general, over time, you want to make sure that you are doing the right thing. So if you want help, I'm going to throw up my link here. If you want help setting up your investment portfolio or talking about how getting some assistance with your investments, designing your retirement income plan, and making sure that you have the money you need today while also getting the growth you need for the long term. This is what we do, right? It's what we specialize in. I'd love to help you out with that. You can go to keepitsimplefinancial.com/talk, and you can book a call right there. Here's the other benefit. We've been doing virtual meetings with clients for the last 4 years at this point, over 4 years at this point. And so, your local financial advisor, you might not be able to walk in the door anymore at this point. we've been doing virtual meetings. We have clients, I think, in 35 states. So we do virtual meetings with clients in 35 states, and we're all set up to help you virtually. So even though you can't go out right now, even though we're still on the lockdown, we can still serve you. My team can work virtually with you, and so we can definitely take care of you. And we have all the tools and everything to make this as easy as possible. And we have clients in their 70s that are able to work with us. And so if you're worried that technology might be a limiting factor and that you just really prefer walking into an office, well, I would say, hey, give us a shot and try, because being able to work virtually, one, it's going to reduce your risk of catching something, because if you are planning for retirement, you're probably 60 or so or older, which is the high risk group. And then as well, just not having to deal with things like weather, traveling to offices, those type of things. And then we also can offer meetings that are off hours, because maybe you can't always go in from 9 to 5 because maybe you work during that time in general. So I would love to help you out. You can go to keepitsimplefinancial.com/talk. We definitely have some appointments available coming up in the next couple of weeks here. So if you're interested, please book a call. Book it soon, because we do fill up relatively quickly. But once again, that's all. My name is Jason Hamilton, certified financial planner, and that's what I wanted to bring with you today. So let me see what kind of questions there are. So if you have questions, I'm going to stay on for a couple minutes of Q&A here. Let's see here. So Tamara said, definitely nerd worthy, but a great visual for the rest. Okay, good. So, Tamara, this is what I'm trying to get at, is like, it's always tough to find a balance, right? Because when you're in this world, like what I do every day, we're just so deep in this stuff that it comes down to just using acronyms almost for everything, so that we can save, a few minutes or a few seconds on our speech. But when it comes to you, the consumer, who maybe this is not your specialty, just like if you're a doctor or a nurse explaining things to me about, what's going on with the virus or how it reacts in your body, I would have no idea what you're talking about. But I wanted to make it simple enough to where you can really get a clear picture on why you should be thinking globally and thinking proper diversification, and not necessarily trying to chase returns when you're so close to retirement. You want to be smart with that, okay? Dan here said, no such thing as perfect portfolio. Yeah, totally. There's no such thing as a perfect portfolio, but if you get, properly risk-adjusted, where you can get, risk-adjusted returns, basically trying to get the most return you can for the least amount of risk, that's where there is some skill, right? So you don't want to just randomly just go select a bunch of funds and hope it works out. Another big mistake I see people is they'll have like 5 different target date funds, right? So they'll have a 2020 fund, a 2025 fund, a 2030 fund, and say, I'm diversified. And it's like, well, yeah, okay, you have 3 different funds, but when you look at those 3 funds, if you were to overlap them, then they're probably like 70, 80 or more percent of exactly the same, same equities, right? So that's not really diversified, and you can't really see what's going on inside those. So if you're one of those people that has 2 or 3 or 4 target date funds, you should definitely book a call, because you need to get you set up here for retirement income. Let's see here, and I'm not seeing any questions, so I'm gonna wrap this up for today. Hopefully you guys enjoyed this. So please come back tomorrow, 2 p.m. Pacific time, 5 p.m. Eastern time. If you have any interest in the government loan programs, they just approved a bunch of funds today, or it's going to get approved. And so the problem that a lot of people had is they weren't ready, right? They went into the banks, they didn't have the paperwork they needed, they didn't have the forms filled out that they needed, and by the time they got everything back, the money was gone. So if you're somebody that's going to be trying to get into the second round of funding, definitely come to our presentation tomorrow. It will for sure help you out, and it'll give you the insight that you need so that you can be prepared to receive these funds. And I think it'll be very, 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 very valuable. So once again, have a great day. If you need help, book a call at the link down below. I'll put the link in the comments as well. Other than that, we'll talk to you soon, guys. Have a great afternoon. Bye-bye now.